Friends, in this video, I'm going to talk to you on the topic rate hikes versus company valuations. When we go through a rate hike cycle, when interest rates keep going up, we are taught conventionally as to how we should view valuations. When interest rates are very low, the case for higher company valuations exists. But when interest rates start rising, we need to revisit valuations. You can't blindly say that a particular company or an industry always deserves to enjoy higher valuations. Valuation will be a function of interest rates. Now, we are in the middle of a rate hike cycle. We don't know how far this will go. It depends entirely on how we are able to manage inflation. Assuming we'll do a reasonable job of it, we still have a few hikes pending. As these hikes happen, we are seeing valuations of companies holding on at higher levels. In fact, large cap valuations have gone up. The Nifty itself is above 18,000. Mid cap valuations are mostly held on. It is only small cap valuations where we are not seeing a upward mobility. I had read one of my friends' tweets that we should look out for a rally in small caps. From a pure valuation standpoint, I am not seeing that case. In fact, the case for a re-rating of mid cap also is extremely weak from a valuation perspective. But sentiment can be a very different animal. It can drive valuations as it pleases. So that is something that we don't know how it will play out. But in a rising rate cycle, there are some simple things that usually happen. There is a divergence amongst financials. The companies which are stronger gain. The companies which are weaker tend to struggle, because when interest rates go up, money moves to the better companies, and weaker companies have to pay much more to attract capital, and capital is their raw material. So they have a raw material problem. So when you look at small finance banks, MFIs, smaller NBFCs, when you look at weaker private sector banks, you need to keep this in mind. Businesses without leverage tend to do better. Companies without borrowings tend to do better because they are not impacted too much. In fact, they are likely to protect their valuation much better than leveraged companies. You know that larger companies enjoy much more stability in such a scenario, and it's reflected in the way FIs have come into this market and bought stocks. Look at their buy list and you'll be surprised. They have bought ITC, they have bought L&T, they have bought a number of PSUs which are throwing out cash, and they have also bought larger public sector and private sector banks. Now, this is a very, very interesting trend that we are seeing just now. But we, the domestic investors, especially the retail, are going exactly in the opposite direction, because we are accustomed by habit and more aligned to what happened between 2020 and 2021. But now we are in a completely different era, and we need to be aware and cognizant of that. Interest rates went down during that phase. Interest rates are rising during the current phase. So probably we need to revisit our investment thinking and not blindly go back and do what we did in that phase. This is where the valuation of small caps seem rich to me, because the vulnerability of small caps to inflation and a high cost of finance environment is a proven thing. It will be difficult for them to raise equity. Valuations will soften with the smallest bad news, and that near certainty of investment outcomes which investors have factored into small companies is coming apart. All these things make it a riskier environment to invest in small caps, But I am not saying that you should not invest in small caps. You should invest very diligently. You can't invest in a small cap based on its past stock price performance or past valuation metric. You have to set a new metric, fresh expectations, and then make your investment with a clear forward looking expectation. That is something which everyone needs to do. Mid cap is a very difficult space because it's too crowded and there's hardly much choice, which is why today you're seeing the FIIs crowding the large cap space. I don't really expect FII money to come down into the mid and small cap like it did in the past. I think it will take much longer for that to happen. So these two spaces are going to entirely depend on domestic capital. As for the mutual funds, I think they are more vulnerable today than they were in 2020. The reason? The portfolio valuation of most schemes in the small and mid cap is rich and it's positioned in such a way that they could be sitting ducks if valuation falls. We'll have to see how their luck plays out. But from an observer's point of view, I am seeing red all over. You may wonder how one can say that when past performance is quite decent. That has no bearing on the portfolio risks from here going forward. So, a rising rate cycle must make us think differently, must make us view things objectively, must make us more forward looking, must create a better risk management framework for our investments, and needs to bring a lot of fresh thinking into our investing. Thank you for watching this video.